All right, friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here along for the ride. As you heard, my name is Jerry Robinson, economist, author of the book Bankruptcy of Our Nation, founder here at followthemoney.com. Great to have you here. We have a lot to cover today. We're going to begin segment one here with a look at gold. So you may see from the title of today's show, gold hits new heights. This is episode number 458. And we're going to be talking in this first segment about physical gold recently touching a new all-time high. And then in segment two, I'm going to get a little bit more into the broader market. I want to look at the stock market here in the United States, also talk about the dollar and Bitcoin as well. So we'll talk about a few other things in segment two. So we got a great show lined up for you. Without further ado, let's dive right in. The price of physical gold climbed to a fresh record high last week amid softening economic data that increased the chances of a June rate cut. Welcome to our show, friends. We do have a lot to cover, and as I mentioned in this first segment, we really want to spend some time talking about and dissecting what's happened with gold recently. If you look at a chart of gold, by the way, for those of you who like technical analysis or are into charts, you may have seen that gold had been forming a very interesting pattern over several years, and we call that pattern an ascending triangle pattern. And physical gold finally staged a meaningful breakout to record levels and smashed above the ceiling on that pattern. And so now when we look at a chart of gold, you may go back and think about back in 2020 amid the COVID situation, we had gold rally really strong, but it ran right into very big, like a ceiling or what we call resistance in technical analysis, around the $2,100 level. And then gold retreated from that area and then made another run in 2022 amid rising inflationary pressures and expectations of higher interest rates. But it only failed once again just below the $2,100 level. And then in mid-2023 last year, gold powered higher, but finally stopped short around the, guess which level, the $2,100 level. And so since late 2023, gold has been back at it again. It's been attempting to power through that same hefty resistance level or ceiling. And last week, it appears gold has finally managed to smash and, more importantly, close above that key $2,100 level. And it's also encouraging that the breakout came amid rising volume, which is usually a sign of more bullish price action ahead. Now, you may recall from one of our earlier episodes this year entitled 2024 Market Outlook, we had talked about our belief that physical metals like gold and silver and even platinum and palladium were potentially set for a market-beating year. This was largely due to the expectations of falling interest rates later in the year. And then so too, if you look at the Fed futures market, the Fed funds futures market, you'll see that investors are pricing in around a 60 to 70% chance of the first rate cut this year coming in June. And that has mainly been due to softening economic data. The Fed has been hesitant to begin slashing rates until they know that the inflation numbers are coming down back to that 2% target that they have. Of course, they're not going to wait until it hits 2%, but they want to make sure that it's on the path towards 2%. And typically now, what's important to remember is that in January and in February, you often have a seasonal impact on those inflation figures. So we are of the assumption that, or we're of the opinion, I should say, that in March, we're going to see probably better inflation numbers signaling to the Fed that they are free to begin cutting rates. Maybe March and April, those months, I believe, will show that further decline in inflationary pressures that the Fed is looking for. But we did have some, weaker than expected manufacturing data in February. And then we also had weaker than expected consumer sentiment data, which again, that's what the Fed is looking for. It's looking for some sign that the economy is responding to these higher interest rates so that it can begin to lower them. And of course, lower interest rates are bullish for things like gold and silver, but also for stocks and other risk assets. But gold and silver, I think will certainly benefit from the tailwind of falling interest rates, because falling interest rates also means a falling U.S. dollar. And I want to talk about the dollar a little bit, as I mentioned in segment 2, when we get there. But a falling dollar, lower interest rates as we head into the remainder of the year, that's our forecast. And so we expect that's going to put even further upside pressure on things like gold. If you look year to date, gold has risen around, as of this recording, about 4.5% year to date. That's not too paltry, considering that the S&P is up, merely 8.4%, and that's really good for the S&P. But to see gold is, nearly half of that gain, that's pretty good for gold, indicating that these risk asset prices, and not even stocks, but gold itself is rising in this kind of environment. Now, there's plenty of reasons why we are long gold. I like gold for the long term as portfolio insurance. To me, it's not a speculative asset. I don't speculate with gold. I don't view it as something to, buy and flip. I don't trade it. But I do believe that because it's been used as a form of currency for centuries, and because it has a proven track record as a store of value, physical gold just tends to serve as that safe haven and retains its worth over time. And as a result, it's often seen as a counterbalance to traditional paper investments, such as stocks and bonds. And of course, the global economic climate is always uncertain. You always have political instability somewhere, and that seems to be increasing. And this instability has resulted in market volatility, which leads to a search for more stable and reliable investments on the part of investors. And so one of the key advantages of physical gold, of course, is that it's tangible. That's unlike, paper assets today. So gold can be held in your hand. It can be stored outside of the traditional banking system. And this means that privately held gold is not subject to some of the risks that paper assets like stocks and bonds are subject to. And it also means that gold can provide a level of security that's not available with most other investments. So, I've always thought that investing in gold, a portion of your money, and I think a small portion, I don't think you should go crazy, of course, with anything. I think diversification is the key. But just understanding that, physical gold can be a smart move. Investing in it can be a smart move for those looking to hedge, against various risks. For me, I like to keep around 15% of my own long-term investment portfolio allocated towards hard assets. And gold is one of those hard assets that I would, include in my portfolio. But there's plenty of reasons, why I like physical gold. It certainly serves as a hedge against inflation. Gold has historically been a good hedge against inflation. Its value tends to increase when the purchasing power of the currency, whatever that currency might be in your country, when it tends to decrease, gold tends to go up. It serves as a store of value. As I mentioned, it's been used as a store of value for thousands of years, and it's likely to continue to hold value into the future. It's a highly liquid asset, meaning you can easily, buy and sell it on the global markets. There's a demand for it. It provides diversification. So when you own gold in your investment portfolio, it helps diversify. It's not like stocks. It's not like real estate. It's unlike those types of assets. And the other really important aspect of gold, I think, is the fact that there's no counterparty risk. You say, well, what does that mean? Well, it means that, unlike other investments such as stocks and bonds, gold, is not an investment that is dependent upon the solvency of any institution or company. No company is going to go bankrupt and then the value of gold goes away or goes to zero. So it's not dependent upon any institution or company for its value. So it has no counterparty risk. And there's no default risk. I mean, gold does not default, unlike bonds or other forms of credit investment. So the investor doesn't need to worry about any kind of issuer default. And as I mentioned, in times of political instability, it can become a safe haven asset for people who are trying to protect their purchasing power from perhaps a decline in their currency. And even people who want to hedge against currency fluctuations. Gold can serve as a hedge, as it doesn't have a fixed exchange rate, so it can be traded in various, currencies. It's also provides some tax efficiency in some countries. Investing in gold can be taxed at a lower rate than other investments, all depending on the country you live in. But perhaps one of the greatest things that I had mentioned about gold is the fact that you have physical ownership. So investing in physical gold allows an investor to take possession of the asset. Very rare, in our world of paper assets where everything is paper. Real estate is one that you can, it's tangible. You can actually touch and feel. There are a few hard assets that are like that, and gold is certainly one of those. But of course, it's important to note that gold, investing in gold is like other investments in the fact that it carries its own set of risks, and there's no guaranteed return. You could buy gold and not get a return. It's not guaranteed that it's going to go up in value in your particular currency. So it's important to understand those risks and do your own research before you make any investment decisions. And before we bring this to a close, because again, gold's at a new record high here, trading just below 2,200 as we speak. And I think we probably are going to see higher prices ahead. I don't have a crystal ball, and if I did, it would be broken. But nonetheless, I do believe that the falling dollar, the falling interest rates here in the United States are only going to serve as a tailwind for gold. And even in election years, if you go back and look at election years here in the United States, you'll often see that gold does tend to have more demand, investment demand in those years. So I think all of that kind of bodes well, for the future of gold in 2024 and even into 2025. Now, I'll conclude this segment by just talking about, the basic ways that you can invest in gold. There's really a few different ways. And quite frankly, many people didn't know how to buy gold for years. It was difficult to access. There weren't a lot of on-ramps, and it's become obviously much more easy to buy gold today, especially in the wake of ETFs. Of course, let's begin though with physical gold. That's the most traditional way of investing in gold. So it involves you basically buying physical gold in the form of coins or bars or even jewelry. And you can store those in a safe deposit box, or you can store it with a professional storage company, and then you can sell it or trade it at any time. So that's the nice thing about physical gold is you've got it, and if you want to sell it, you can sell it. You can liquidate it usually very quickly. So physical gold, in my opinion, is the best way to own gold because it really gives you all the benefits of gold ownership. Nevertheless, it's understandable that some would, need to do it maybe through the stock market. And if you do that, you can use ETFs. And the very first spot ETF for gold came out, I believe it was in 2004. iShares, which is owned by BlackRock, is the one who came out with that. And when you look at a chart of gold from that time, you'll see that there was a lot of demand that came in because this new spot gold ETF released by BlackRock, 20 years ago, provided a new on-ramp for people who didn't really know how to buy gold and they wanted to get some diversification. So, that's another way that you can buy gold. It's not my favorite way to buy gold, but if I didn't have any other way to do it, that's certainly one way you could do it. And I would certainly investigate those ETFs and figure out which one do I trust the most, which issuer do I trust the most if I'm going to be doing that. And then there's a third way, of course. Well, I guess there's four ways. You could also use futures and options. Those are ultimately financial derivatives that allow you to speculate on the future price of gold. That's really just speculative, though. I would much rather hold, again, physical gold, when it comes to that type of ownership. And then finally, there are gold mining stocks. There's a way of investing in gold through the stock market aside from spot ETFs. And that's by buying shares of gold mining companies. So these are the companies that actually dig the gold out of the ground or that stream. They have royalty streaming deals where they make money off of other people's mines. And so, you can buy shares in a gold mining company. And this basically gives you exposure to the price of gold as well as to the performance of the company. And that can either be good or bad because if the company is not run very well, the price of gold can be going up, but your company may not. And so there are more risks involved when you deal with mining companies. And of course, there's also potentially more rewards because gold, is not an asset that just soars in value. It doesn't go up, 100% per year or anything, but sometimes miners can do really well, especially in big bull market cycles. The problem is you've got to really do your research and figure out which ones are going to, do well. And they're beholden to many problems. They're beholden to all the typical things that you would have with, single stock risk. So in that case, for the average person who's wanting to get involved in gold mining, usually the best place to begin would be with an ETF, a broad-based ETF that gives you exposure to many mining companies. That way, you just don't go out and pick the wrong one and then end up, with a worse performance than you would have bought than just buying gold outright, for example. So that kind of gives you a nice summary of gold. Here it is at a new all-time high. Very glad to see that. Everyone who has ever bought gold now is in the black. And if you bought 10 years ago, 20 years ago, 5 years ago, 1 year ago, you're in the black. I mean, gold's at an all-time high. And we don't think that this is necessarily the end. It may not, keep going straight up, of course, here. Probably it's not going to, but it might. And we do expect to see generally higher prices as we move forward with rate cuts and with a declining dollar. So I think that's good news for gold investors. And again, we keep a small allocation towards gold. It's not a huge allocation. We view it as portfolio insurance, not as some sort of get rich quick, asset. So, all right. So that segment, well, I want to move into our next segment here after this break, and I want to move into a more broader look at what's been happening in the financial markets. We're going to look at the S&P 500, the Nasdaq. I also want to talk about Bitcoin and the US dollar. So we'll talk about all that on the other side of this break. Hold tight.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back to one of the longest running financial podcasts on the web, Follow the Money Radio. Great to have you here. You can find us online at followthemoney.com. My name is Jerry Robinson, and now we're going to move into a bit more of the financial markets. We're going to talk, and let's begin with the S&P 500, the largest and most liquid of the broad market indices here in the United States, the one I certainly track, the one that most people around the world who look at the United States track, the S&P 500. And quite frankly, the S&P 500 is the index that Warren Buffett says that, hey, if you don't know what you're doing, just invest in SPY. I mean, I'm not an investment advisor, but Warren Buffett seems to know what he's talking about, and the S&P 500 has continued to deliver market-like returns. And I often tell our students and members here, if you can't beat the S&P 500, then just look into it and see if it's right for you, because quite frankly, most people can't beat the performance of the S&P 500. And this year, again, probably no exception. This year has been a banner year so far for the S&P. Over the last 20 weeks, we've only had 3 negative weeks. Isn't that incredible? That is simply incredible. We're 20 weeks in now to this rally, and only 3 of those weeks have been down. That means we're on track. We've already had 16 weeks up. And if we close higher this week, that'll be 17 weeks out of the last 20. That's historic. I mean, that you have to go back decades and decades to see anything like this monster rally that we're enjoying right now, which, by the way, enjoys pretty good volume. So volume is really important too. We're seeing good volume flows coming into the S&P 500. So that means, investors are participating. And by the way, there's still a bunch of money on the sidelines. Right now there's still $6 to $8 trillion sitting in money markets, earning, 4, 5, 6, whatever they're earning, 4 or 5%, or maybe not money markets. They may not be earning that much, but CDs and things like that. There's a lot of money on the sidelines, earning some percentage. And, and so there's a lot of money that could flow back into this market. We believe as the Fed begins to ease on the interest rates and the dollar comes down, we're going to see more price increases ahead or for these asset prices. And, this has been pretty much a hated market rally for the last several months. I mean, we're beginning to see more broader participation. For example, right now, 80%, maybe almost even 81% now as of this recording, of stocks within the S&P 500, which obviously has 500 stocks, 80% of them, or 400 of them, are trading above their 200-day moving average. And for those who don't know what that means that they are, they're actually, doing pretty well. They're actually not, moving down. So in other words, there was a kind of an idea that this was just a rally that was based around the Magnificent Seven. Just the really big market cap stocks were the ones enjoying the rally. But that's not really the truth anymore. We're seeing a broadening out of this rally, and now 4 out of 5 stocks in the S&P are participating. They're above their 200-day moving average, and they're moving higher. So I think that's pretty good. Now, but as I mentioned, this is a hated rally, and part of the reason why is because of something we call recency bias. You know, recency bias is real. It's a real issue that can happen to you whenever you see something happen and then you think it's going to repeat. So we've been through a traumatic phase here in the financial markets since 2020. You know, the markets were doing okay in 2019, but then when we moved into 2020, we had this crazy market crash with COVID. And then, of course, it rallied up. And then we had a great banner 2021, followed by another really harsh 2022, you know, and then we had a recovery in 2023, and then 2024, it's just been off the charts. And so the recency bias that many people feel is that, well, you know, the market has to go back down again, you know, because it was just down. And so this causes some people just to miss out on rallies, and it's understandable. I mean, we're not pointing blame. I mean, we're not saying people are, wrong for falling for recency bias, but it's just something that happens. It happened in the wake of 2008. In 2008, we had a crash. We saw it coming. We talked about it back at the time. In fact, my book was written around that topic. But in 2009, our trading system gave us an all clear. And it was a great time to begin investing, but there was a lot of recency bias at that time. So people thought, no, the market's not going to go back up in 2009. And of course it did. And then 2010 came around and said, well, it's going to crash again, right? Well, no, 2010, it went up. And then 2011, so you had this recency bias. And I think we're going to have that same thing around this time frame here. 2020 and 2022 were pretty brutal. And so that's fresh in our memories. And so we assume that it has, some people assume it has to go back down. Well, it's possible that it could. I'm not saying that it won't. I mean, it certainly could. But our trend trading system, if it does, we're going to catch it. That's what our trend trading system is designed to do. So our members are going to know. If you're sitting around worried about the market going down, well, that's what our system does. I mean, our system is designed to detect new downtrends and new uptrends. And so we called an uptrend, in the S&P 500, back at the beginning of 2023. I mean, it was January 13th, 2023. We issued a position uptrend to our members, and then we issued what we call a long-term. I mean, this is the big granddaddy of all uptrends. We called a new long-term uptrend on June 2nd, 2023. And since that time, we haven't changed. The market remains in a long-term uptrend according to our system. Now, when the market is no longer in a long-term uptrend, our system is going to tell us. And then we're going to tell our members. And in fact, our members have our system, so they'll see it just as quick as I will. So the point is that, if you're worried about a market crash, are you falling for recency bias? Maybe the first question, because again, we are in a major uptrend right now. And the last 20 weeks, we've only had 3 down weeks. So there's, as far as a crash goes, that's not really, it's kind of going the opposite direction you would expect. But then B, if you are worried about a market crash, well, you got to have some sort of system. You got to have some way to detect it, And that's what we do. I mean, that's exactly what Follow the Money does. We follow the money. We follow the trend. And instead of giving you opinions and saying, we think the market is going to crash because, we're smart. Okay, we don't know. I'll tell you right now, I have no clue what the market's going to do tomorrow. And I don't think you do either. I mean, I don't even know what it's going to do next week. Now, over time, I think it's going to go higher. I think if you say, well, what's it going to do in 2 or 5 or 10 years? I think I have a pretty good idea. But if you ask me what it's going to do tomorrow, next week, or next month, or even over the next few months, I don't really know. But right now it's moving higher. And so until it stops, we really don't have a reason to say, well, it's going to stop. And that's kind of futile. That's where people can really get into trouble, I think, in the markets, is where they try to guess, right? They try to make up ideas, and they say, this is what's going to happen. And then if it doesn't happen, well, then, you just lost out. You just lost out. You were wrong, And hopefully people, when they're wrong, they just kind of lick their wounds and move on and say, well, I'll learn from my lesson. But some people don't. They just keep doubling down, They just go, I'll be right one day, Well, yeah, you might, but you've only got so much time. You've only got so much time to do this. Time that you have is, limited. for where you can grow your wealth, you can kind of compound it, you can do things to kind of get ahead and diversify yourself. But if you're always waiting for a market crash, well, you're probably not really invested, or you're probably invested not very diversified in a very diversified way. So the point is that, for those, I know there's a certain segment out there of people who are obviously worried about a market crash. And to those, I just tell you, right now we're in a massive long-term uptrend. We've been like that since June of 2023. And B, when the next downtrend comes, we're going to alert our members. So our members are going to be the very first to know when the market forms a new long-term downtrend. But we don't see that anytime here immediate, right? We're not seeing that appear on the charts. We're not seeing signs of that right now. Okay, I don't know why I said all that. Maybe somebody needs to hear it. Well, anyway, let me continue on. So the S&P doing good. As we mentioned, it's continuing to rally. The Nasdaq 100, one of my favorite markets that's been a niche of mine for a long time. I like that market a lot. That one also doing very well, recently hitting an all-time high not too long ago. And it's just powering higher, big long-term uptrend there on the Nasdaq. And it's even hasn't even come back to its 50-day moving average since last November. So we've had a really big rally there. We've already talked about gold, and I will add the U.S. dollar now. The U.S. dollar is a very important market to track if you're an investor. But I found over the years that very few investors, let alone traders, fully understand the impact of the U.S. dollar on asset prices. But in the simplest terms, the U.S. dollar, when it's rising, that typically signals that investors are seeking safety and stability in guaranteed U.S. assets, and they're moving away from riskier investments like stocks. But when you have a weakening dollar, that usually signals that investors are more willing to take risks, including investing in stocks. And so over the last several years, we've seen some really big moves in the dollar, where the dollar reached its peak for this current cycle back in late 2020 or mid to late 2022. And it did that because interest rate levels were rising. But we've since seen the U.S. dollar really fizzle. It's trading back below its 200-day moving average. We just got a big move down below the 200-day moving average not too long ago. And we've been shepherding our members through this tumultuous economic period by providing weekly key insights on the U.S. dollar and many other markets. And we've advised our members to expect no dollar rally above a certain level this year. And it's really turned out very well. So the U.S. dollar now trading back below its former 200 simple day moving average support level. And we expect more downside ahead for the dollar as investors expect interest rate levels to decline later this year. So that's really worked out well. The dollar now really showing signs of weakening. We think that is a trend that's going to continue. And again, we don't expect it to go straight down, of course, but the dollar is weakening after being hit relatively strong since its rally began in 2021. It had a really nice rally. The index ran from like 88 all the way up to like 114 or something. So it was a really big rally, but it's since been deflating. And we expect more lows ahead, and we expect a further downside pressure on the dollar. And when that happens, that pushes asset prices up. Right? That's how it works. And what's the price of the dollar? Well, it's interest rates. So if you lower the price, or if you lower the interest rate, you're lowering. It's going to lead to lower dollar index value. So we have that. We also have been watching China. China is quietly breaking out right now. We've been watching it for months and, well, for years for that matter. But recently we've started to really dial in on China, and we're going to be providing some more insights on China, real specific insights on our next live Trends and Profits webcast, which is next Tuesday. So if you're not a member and you're not getting access to our live weekly webcast for investors and traders, you're just really missing out. So be sure to check it out. You can go to followthemoney.com, check out our plans and pricing. But the Trends and Profits webcast every Tuesday live, we provide a lot of great actionable insights and economic updates and market updates and investing updates and trading updates, all kinds of stuff, Bitcoin and gold and the stock market and real estate, all kinds of stuff. Well, anyway, let's move now to silver. Silver this morning, as I record this, is making a big move. As of right now, in the middle of the day on Wednesday, the 13th of March, we have silver breaking out above 25 for the first time in a little bit, right? It's been a little bit. And so silver now really pushing higher, and we're seeing a nice rally here. There is some major resistance overhead for silver. We would say up to about $27, you're going to have a pretty rough ride. But once you get past that level, we think silver could also go on a nice extended rally. And so we are bullish on that metal this year, specifically due to that falling dollar. Again, that's why we have some expectations of rising silver prices in addition to gold prices. Also, we've also begun to see some pretty interesting strength in crude oil, U.S. crude oil in particular, perhaps more so than Brent crude, which is the more global crude oil market. But West Texas Intermediate, we like to follow that with a particular ETF. And we saw that ETF this morning just stage a new 200-day moving average breakout, not on massive volume, but nonetheless, we did get a breakout. We do think that oil could maybe rise a little bit further here. We've begun to see some uptrends begin to form in several different oil-related ETFs and stocks. And so that also looking fairly interesting there on the charts. Now, let me conclude with just a couple of other points. I want to talk about Bitcoin, and Bitcoin, of course, having an incredible rally, now trading up around $73,000. You got to remember that at the beginning of this year, Bitcoin was trading for less than $50,000. In fact, I think it was trading for around $42,000 or $43,000 at the beginning of the year. So we've had a monster rally this year in Bitcoin. And again, once again, this is not a market that we think is going to, not perform well throughout the year. In fact, we expect Bitcoin to continue to do well this year and into next. And in fact, we just did a really big video for our members. Well, in fact, we just did the Bitcoin halving episode on this podcast not too long ago. So we talked about the Bitcoin halving and our forecasts and everything. But we really laid it out for our members, one of our recent webcasts. And we shared the interesting cycles on Bitcoin and talked about what could lie ahead. But year to date, Bitcoin's up around 72%. How about that for a nice rally? It's almost up as much as Ethereum. Ethereum's up nearly 75% year to date. So these have had monster rallies this year. But this wasn't a surprise to our members because we had really seen the writing on the wall at the end of 2022 and really began to see the market, begin to move higher. So we've really had a nice rally here in Bitcoin, and we continue to see more upside ahead for it. Ethereum also trading up near $4,000 as we record this episode. You got to remember that it was trading at just above $2,000 at the beginning of the year. So it's had a really big run this year. So we are bullish on cryptocurrency, not all cryptocurrency, but some specific cryptos that we like. We're also bullish on gold. We're bullish on the Nasdaq 100. We're bullish on these things this year, and we expect to see more upside ahead, especially when you look back at previous election years. This just tends to be a time when you see the markets tend to do better than other years. So historically speaking, we have that on our side as well. Well, we have a lot more insights that we like to share, but we do that on our website with our members. You can learn more about us, followthemoney.com, right there on our website. Also, click the plans and pricing if you're not a member and learn more about our different plans that we have. No matter what level you are, if you're a brand new trader, brand new investor just trying to get started, or maybe you just want to learn more about how the economy works and how investing works and how you can participate and grow your nest egg in a diversified way. We've got a lot of great tips here for you as well. We also have our 5 levels of financial freedom for everybody. That's completely free on our website. So be sure to check it out. And of course, this podcast is brought to you completely free as well. So be sure to subscribe to this podcast if you're not already and stay locked in for all of our updates. We love to educate, equip, and empower you so that you can be a better investor and trader. All right, friends, well, that brings us to the end of today's broadcast. It's been a wonderful joy to be with you today. I sure hope you enjoyed today's episode. And as always, I'd like to leave you with a final word, this time by the great investing legend, Peter Lynch, when he said, "There is no shame in losing money on a stock. Everybody does it. What is shameful is to hold on to a stock, or worse, to buy more of it when the fundamentals are deteriorating." And that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial